Hey guys, my name is Ken Trades. I'm a 2-year student of ICT and 1-year student of IPTA-X and a couple months student of Time Then Price. There are a lot of concepts that ICT talks about and the mentorships that I have mentioned, IPTA-X and Time Then Price, they kind of do a lot of the legwork and filling out a lot of the concepts that ICT neglects talking about. So some of those concepts I will reference and do my best of explaining in this video. But yeah, let's go ahead and get into the video. So what we're going to be doing is kind of breaking down what ICT talks about in the current day's live stream and the concepts that we're going to be framing these trades around. So a lot of the time I will be listening to the live stream and executing based off the logic that he is describing in his video, but he's not acting on. So in this current chart, we see that we have these NDOGs, new week or new day opening gaps marked out, denoted by these purple boxes. On the 8th, August 8th, Thursday today, or whenever you're watching it, it's the 8th of August, 2024. He described that new day opening gaps and new week opening gaps are very strong magnets to price that rival, or if not, are better than relative equal highs and inefficiencies below or above market price that he described in the first video that he put out in this lecture series, which was on Monday of this past week. So taking that into account, we're going to start with some of the logic that he explained in the very beginning of the live stream and kind of as market plays out where I think the valid trades occurred. So if you haven't watched his live stream from the 8th today, go ahead and watch that. This video is probably not going to be that helpful to you unless you already have those concepts that he's kind of mentioned already. So kind of going chronologically in order of the logic that he walked us through from the very beginning of the live stream to the end, he explained that if we are in between two new NDOGs, I'm just going to refer to them as that, we need to wait for price to do something before we determine the draw on liquidity for today. And before we even get to that, he said it's very important to mark out relative equal highs, inefficiencies, and new day opening gaps and new week opening gaps because those are the magnets of price. So we did that. Purple boxes are established. Up here is the new week opening gap. Right here is an NDOG, NDOG, and NDOG. We open up right here. Price displaces. What do? Nothing. Price can really go anywhere at this point. We need to see something significant happen, such as manipulation occur before we even start framing a trade. So what we see is we see relative equal highs being formed around 9:30. 9:30 price dips heavily into a discount of the overall range. I'll show you the overall range right quick that he pointed out during the lecture, which is this high and this low. Why is this the new range? Because we took out a high, this high, and we took out this low, which is, these lows aren't technically really important. To establish a new range, we really just need to take out a high and a low. So since we took out this high, when this candle displaces through this low, that's the range. Displaces through this low, that's the range. Then we kind of start to reverse. Then we see, okay, this is our current range that we're working in. Then from there, we want to really look at what are the points in price that act as liquidity and inefficiencies. So within this range, we have a inversion fair value gap within the breaker that he describes in the video. So this is the high, low, higher high, lower low, which is the range, which is the breaker. And he said inversion fair value gaps within the leg of a breaker are typically magnets to liquidity. So we're going to go ahead and slap that on our chart as well, as well as the NDOGs and NWOGs. So that's what we have. That is the markups that we're going to be rolling with for the explanation in this video. So I also denoted the range by the scan box, and we can see this 50% level of the range aligns with an NDOG. So we're about to get into why that's important. So here we are. back on the 1 minute, and we see that price has dipped down to an area of inefficiency. Price is always moving from inefficiency to liquidity. So since we refilled this fair value gap and respected this end dog, and we saw that bodies were really respecting this area of price, we looked below it a little bit, but that's fine. Then we see displacement away from it. So that tells us that this was a retracement to go higher, because we partially filled this inefficiency. We see bodies respecting this PD array, and we displace away from it. So that is our key indication that we're likely to move higher. So now we kind of want to start framing, how could we get in this trade? We see another new day opening gap just above that. Price displaces above it. It dips into it a little bit. Bodies are respecting it. This is also institutional order flow intradrill, as ICT describes, which is having a shift in market structure, which is having a fair value gap on the low, a high in the middle, and displacement beyond the fair value gap, which is the first candle in its formation. So we displace above the first candle in its formation right here, and we are also in a PD array that we displaced past. So that's kind of a double confluence for us to say, okay, this might be a good area to get into, as we're about to target the higher draw on liquidity, which is that breaker inversion fair value gap and new week opening gap above price, denoted by this purple grayish box. And on top of that, we have another draw, which is relative equal highs. So what I did was, I'll go ahead and show you what I marked up. So these red lines mark out where I entered and where I exited. So I'm going to show you my paper trade for this. We are using NQ micro accounts. We are using just one contract. If you recall ICT's first video in this lecture, he says, don't use anything besides one micro contract. It is very hard for you to blow an account if you use one micro contract. And I used one micro contract right here, even though I'm still learning from his 2024 lecture. I want to have a little bit of skin in the game, have a little bit of an emotional investment into it. Like, my eyes are going to be more likely drawn to relevant areas on the chart when I am actively in a trade or a hypothetical trade. So that's why I paper traded this. So we entered here. The confirmation I wanted to see was, we wanted to kind of respect the top of this end dog, and we get IOFED, institutional order flow entry drill. Then we see price start rapidly spooling away during a macro. A macro is a 30-minute area in time where the market typically reaches for inefficiency and liquidity. So we see that during this macro that I have labeled here, 9:45 to 10:15, we hit an inefficiency. We hit a roadblock, which is this end dog. Price respects it pretty well, displaces away from it, go into another PD array. Price quickly pierces through that as well, respects it by giving us IOFED. That was the confirmation we need to enter. Then where are the logical points that we can get out at? Typically, people will try to go for the highest draw on liquidity, but there is no guarantee that we are going to hit any draw on liquidity at any session. It could take minutes, days, weeks, or even months to hit areas that ICT calls out. But we know this is pretty likely to hit because these are huge magnets in price. And since we only have one contract, we just kind of want to aim for the low-hanging fruit just to build up our reticular activating system to be able to catch these trades in real accounts when we eventually do make it there. So the low-hanging fruit, in my opinion, was these relative equal highs. Going back to his first lecture again, he said anytime you see a high with a failure swing, this is going to be the easiest low-hanging fruit that you could possibly aim for. So that's what we did in, what is that, I guess 1, 2, 3, 4, 5 minutes time. We got one candle from 18,184 all the way up to 18,253. I'll go ahead and show you that's what we moved from. So 18,185, 18253. And that was a very easy, I think, $120 to $150-ish trade, just utilizing the concepts that I have gathered from his prior mentorships, my current mentorships, and what he's teaching today. So the real purpose of this is to give you a kind of intermediate perspective and actionable trades that ICT does not take, but I do take during his daily live streams. So be on the lookout for more of these videos. Please do like and subscribe so you can stay up to date. If you're ever confused about any of what he's talking about at a certain time in any of his lectures, leave a comment and I will do my best to explain the concepts that are being utilized at the current time and price that you're curious about. But that's about it, guys. Again, my name is Ken Trades, and I'll see you in the next video.